Repercussions of the coronavirus are not yet fully known. It's evolving. So at the present moment, we are building a 3 to 5% earnings cut on the Nifty based on whatever we are hearing. And this is post Q3 FY20 numbers which have been declared. So that's where we stand. And based on how the outcome shapes up, we'll have the Nifty earnings, take shape accordingly.
Aside of the virus scare, do you think there is a possibility that the markets, and not just us, but even US equity markets, which are clinging on to those record highs, they may just fall under their own weight?
Yeah, I mean, it's very negative for the global markets per se, and Indian markets are also going to fall in line with whatever the global markets have been doing, and are going to toe in line with exactly with the global markets. But I think the divergence could happen in the broader markets. The headline indices would emulate whatever is happening in the global markets, and if they are falling, and if we are hearing that new cases are being reported outside of China, I mean, that's a worrisome data point that's come through this morning. And from that point of view, if the global markets are standing weak, of course we can't rise, and that's as far as the Nifty and the Sensex is concerned. But you could see divergences in the broader markets per se, which is an under-owned space, and there you will have a few winners here and there.
Do you sense, Manish, that irrespective of what happens at an index level, the broader market recovery would stay intact? And would money then tactically move out of large caps and shift to the mid and small cap end of the market, selectively albeit?
Yeah, I mean, the large ETF flows are all, dominated by the large caps. So if you have global outflows happening in equities, I mean, that would ultimately mean that you'd have money moving out of the large caps. I mean, this is the world of passivization. Large flows on the ETF side can swing the the headline indices big time. And that is how the divergence has shaped up even in the previous month. If you were to see, the Nifty actually fell by 1 percentage point, whereas the broader markets, which is the NSE 100 mid cap and the NSE 100 small cap, they actually gained 6% in the last month. Of course, earnings were not that great for the mid and the small caps as far as the Q3 numbers are concerned. You had more misses in the mid and the small cap space as opposed to the Nifty. But having said that, there has been a lot of fund outflows in this space over the last 2 years, and there's some catch up in the divergence which may be happening. And of course, the companies which have actually met their numbers in Q3 would actually see some resurgent movement on the upside.
What's your take on financials, Manish, given the hefty weightage and the fact that post earnings as well, still pretty much status quo in terms of reflecting any kind of improvement? On ground, of course, we've started to now hear that perhaps there is a change, that we are starting to see a credit uptake. There are signs. Could be too early to tell. What's your outlook when it comes to the financials, and any particular way that you're segmenting your picks in the sector?
Yeah, so if we look at Q3 numbers as far as the financials are concerned, we have seen slow credit growth peaking out of net interest margins and aggravated slippages. I mean, that has been the case for the financials. And now with the slowdown persisting and with the coronavirus thing also coming around, I mean, you could see some heightened slippages going forward. So of course, valuations are something which cannot expand from these levels for the financials. There's increased risk on slippages. But having said that, locally we're seeing some green shoots on the credit growth side. There's negative carry as far as the banks are concerned. Liquidity is ample, but a lot of that is getting parked in treasuries. Cost of funds is higher than what the yields on treasuries are, or the reverse repos are, thus attracting negative carry. I mean, for how long would the banks be having a risk-averse opinion and continuing to attract a negative carry? Of course, the recent measures by the RBI would mean that they are incentivizing banks to actually lend out to certain sectors which are in distress at the present moment: real estate, SME, autos, this could be a sign of some pickup in credit growth. But having said that, I think NIMs have peaked out, and there is some risk on slippages side going forward.
What is it that you're making of the sudden U-turn that the US FDA took after that relief which came by only on Thursday on Auto Pharma? This is turning out to be a bit of a mockery. I mean, just when you thought that selectively pharma prospects were getting a little better, you get a news like this, the first in its history, I think.
Yeah, I mean, came totally out of the blue. So, the key takeaway is that the outcomes on the US FDA, is totally unpredictable. You can't really be sure about what sort of diktat can come through. And in short time frame, of course, what we heard on Aurobindo Pharma was never heard in history ever before. Just a day after it was given a clean sheet, you had a OAI again coming through. I mean, you have huge repercussions on the stock the previous day and today as well. But, it just goes on to highlight the unpredictability about US FDA.
Circumspect investing in pharma at all, given this case an example?
So the pharma pack is actually doing quite well. Even in the previous quarter, we've seen some very strong domestic pharmaceutical growth come through, and certain segments actually grew quite well. So anti-infectives, gastro, pain management, they actually grew quite well. There is a whole lot of API opportunity coming out of the problems in China due to the coronavirus issue. So companies like DVs or let's say Aarti, which have a big presence in the API space and API export space, are doing quite well. What we have also seen is that the third quarter we have seen some very steady US sales. So we have not really seen too much of price erosion come through in the third quarter as far as the US generic exports are concerned. So that's lending a helping hand to the overall pharma pack as a whole. But I would say that the companies which are having a bigger presence in the domestic pharmaceutical space are in a sweet spot. Growth is pretty steady in that space, and valuations also expanding. So pharma IT would be the preferred picks in a risk-averse environment like these, I would believe.
Manish, while the government is talking about a stress fund for some of the distressed telcos, how are you looking at the overall story that's panned out with the mammoth amount that these companies have to shell out? Do you believe that, as of now, we wouldn't really see too much of a relief coming in, and there will continue to remain stress for the likes of Vodafone and Bharti Airtel?
No, so if the stress fund does come through, it would be a big helping hand for the telcos per se, and particularly Vodafone Idea, which is on the brink. That could be the deciding factor whether they continue in business or not. And of course, that would have repercussions across the telecom space, particularly the remaining two large incumbents, which is Reliance and your Bharti. It will have a repercussion on the ARPUs, it will have a repercussions on the subscriber addition, it would have repercussions on the revenue per minute. So I would believe that something like this stressed fund would be quite helpful for the telco space, the confidence in this space by the operators themselves, and that would be something which would be looked at very positively by the markets also.
Okay. Manish, how bullish are you on insurance? How much of an opportunity do you see there? We've got deal buzz happening in the space. The recent growth figures for the industry have been a little volatile the last 2-3 months. Regulatory hurdles always something that one keeps in mind. But how much of an opportunity do you see in this space?
Yeah, the only name which has some value left on the table would be your Max, and the news flow surrounding this company are indeed quite positive. But having said that, whatever we heard in the union budget pertaining to life insurance companies and the disincentivization of savings have had a impact on the valuations of all the major private life insurers, which were in any case richly valued. That is not to say that the sector is not going to grow. It is going to grow. Of course, the volatility which we have seen in the previous few months is likely to continue. But this is a sector for the long haul, and the large players would continue to benefit. But I would believe that for the next 6 to 12 months, valuations in all the private sector life insurance guys who are listed are rather full. Earnings have been fully discounted, so to speak, but there's ample value on the table in only one, and which is your Max Life. And if you were to just value this company at 2.6 times EV, embedded value FY21, then any price between 700 and 750 is possible for this company.
Okay. What about the consumption space? Within that in specific, HUL, they have managed to brave the slowdown storm so far, but the valuations that they command are quite expensive. How are you looking at, the overall earnings of the consumption players, and where does HUL stand among the basket?
Yeah, HUL will continue to gain, I would believe. Broadly there were muted expectations as far as the FMCG pack is concerned in the Q3 numbers. I think numbers have been by and large been met. And of course, not to say that the rural part of the economy is reviving because of three things. One is that gold prices have risen approximately by 25%. And roughly 65% of the total household gold which is there in India is there in rural India. So you have a positive wealth effect coming in from that side. You have global agri product prices move up, and locally also we have seen agri product prices move up. These three things would lend a helping hand to the rural segments which have been suffering over the last 2-3 years. So HUL is a direct play on the rural theme, so to speak, and not to say that company specific they are the best in class, whether it comes to premiumization, whether it comes to volume growth. Even the volume growth in this sort of an environment of 5 to 6% is a very good number, and margins have been helped through benign commodity prices, so they have been able to defend margins. And should the Brent or the oil prices continue to fall for whatever reasons, it would only lend to protecting or even moving up the EBITDA margins on many of the FMCG companies. And of course HUL is a leader in the pack. I don't really see how the valuations are going to contract in this one, because in this sort of an environment in the FMCG space, this is one company growth for at least the next 2 years. So given that visibility, the risk averseness in the entire economy, there is surety on this name, and you'll have many of the funds actually look at this name as a safe bet, and I don't really think that you will have valuations fall on this one.
Aside of that, Manish, just the rich valuations besides Unilever that the rest of the pack as well is trading at, be it an Avenue Supermarts, a Trend. This is of course, the high valuation, high price category, not just purely restricted to FMCG, Aditya Birla Fashion, Nestle, Berger Paints, Pidilite, Unilever, Asian Paints, Bata. And, one really is not seeing the high price, high valuation concern really plaguing any of these names. They're only getting more and more sought after, irrespective of their prices or valuations as the day progresses.
No, so, within the FMCG space, if you have names like, let's say, HUL or names like the entire paint sector. Paint sector has very good visibility of something like a 15 to 20% earnings growth for the next 2 years. There is increased visibility on this name, but you're right, in some of the names like Bata, where expectations were higher than what the numbers came through in Q3. But you have these names getting chased because these are safer bets. they're unleveraged plays, and the long-term story, etc., will continue to play out in these. So be it one quarter where the earnings have been, not met, but in the overall scheme of things, it's just that the postponement of the earnings coming through, getting reflected in valuations, is a function of how funds are chasing many of these names which appear to be safer bets. Retailing on its own part, have done quite well in Q3, and I think this is a direct play on the shift from the unorganized to the organized. You are really seeing some very good traction in all the retailing stocks, whether it is Jubilant, whether it be Titan, whether it be Avenue or Trent or V-Mart, etc. So this is one space to watch out for as far as good earnings growth is concerned over the next 2-3 years. I would believe the real shift is starting to play out in this space.